Hey everyone, hope everything's going well. I hope you had a nice New Year's, and hopefully this year will be a great year. Now, when making this video, I hope I'm totally off on this, prediction for 2024. But I have a feeling that something really, really negative is brewing underneath the surface in regards to the macro. And then it will spill over into the stock market later this year. In my opinion, I'm not telling you what to do. Talk to your financial advisor and have a strategy that's best for yourself and your own portfolio. Okay, do not do what I'm saying here. I want to reiterate that. Okay. Now, here's the thing: the Fed is going to be cutting rates this year, and they were predicting late last year about 3 rate cuts. And as early as March, but some of it saying in May. Initially, when they cut rates, when the yield curve is inverted, that may create a rally, just like you saw a rally in 2007. Up until October of 2007, yield curve was inverted. They were in the process of cutting rates, bada bing, bada boom. It initially helped the markets. I think we're in that same scenario where a lot of people are very optimistic about the economy because they say, hey, look, the stocks are up. I've talked to many rich people, and what have they told me? They said that the stocks are up. Yeah, that's great. My portfolio is up. The bonds are up in value as well. So I'm just thinking, all right, we have a negative yield curve right now where the Fed funds rate is 5.25. The 10-year yield is less than 4%. The spread between the front end of the curve and the 10-year yield is about 125 basis points. That is huge. This is not a small inversion. This is huge. The bond market is screaming. They are saying, hey, look, like how in the 19 or the 1700s, that called the British are coming, the British are coming. And the bond market saying the crash is coming, the crash is coming. That's what I'm seeing. I hope I'm wrong in how the recession will play out. This, in my opinion, is not going to be a short recession. This is not going to be like 2020 in terms of, the markets. Okay, yeah, there were unfortunately job losses, but what ended up happening was stock market picked right back up. Very, very short recession in technicality speaking. The markets did crash hard in March of 2020. I think it's February and March of 2020. Rallied back up. And eventually people, right now, things have gotten better, or they seem to have gotten better. What's going to happen when commercial real estate blows up? And commercial real estate is not only related to the office buildings we go to work at, it's also investors that have poured money into rentals. And here's the thing, interest rates went up. So they have to roll over their debt at a higher interest rate. Now, if they bought it like 10 years ago, okay, they're fine. I talked to a guy in Atlanta. He said he was buying real estate when it was cheap. So he's fine. Now, he's not able to invest in new properties that's making him a lot of money. That's what he said. It's dried up. It's not easy money anymore. What I suspect is going to happen is the not commercial banks, but these Smaller banks out there, regional banks, are going to get hammered come spring. I think it would be like March, April. You're going to see signs, in my opinion. And the overall markets, in my opinion, are going to top out near March of this year. Not March, May of this year. So around May. And that falls in line with the cycles of a presidential year. I remember J.C. Peretz talked about it when I saw a presentation of his when he came to Chicago. So, yes, October to December of last year, that was a strong stock market rally, as expected. That was based on a cyclical play. I do expect a cyclical play up until, like I said, May or June of this year. And then crazy things are going to happen, okay? So I'm just looking at this history repeating itself. Because here's the thing, though. When you have an inverted yield curve, going back to the yield curve, what does that mean? It's saying that, hey, look, the longer term interest rates are lower than shorter term interest rates. So you have to ask yourself, why are longer term interest rates less than shorter interest rates? Why are they pricing in lower growth expectations in the future than right now? I mean, you could even look at like the 2-year yield. It's less than 5.25. You can look at other interest rates as well. There's a problem, underlying problem in the economy. Why are they pricing in shorter interest rates at a lower interest rate, at a lower yield than right now? The bond market is telling you what's up. They're the smartest people in the room, whether we like it or not. It's $1 trillion market, okay? Can't do all sorts of, what I said on my sports car channel is hanky-panky in the bond market. So I'm just looking at that. I'm looking at history. All these recessions have shown an inverted yield curve. There's an inverted yield curve in 2000, 2007. Go back to many recessions, after 1950, inverted yield curve. This is how the system works in fractional reserve banking. You borrow short and you lend long into longer term securities. Now, if you're borrowing short term, where the short term interest rates are greater than the long term interest rates, where are you going to get that yield from? This is the underlying problem in the economy. The banks are going to get hammered. And Avi Gilbert, this is not my research, Avi Gilbert, a successful Elliott Wave trader guy, he projects that we are going to have a banking crisis. This guy is not some doomsday prepper, okay? He thinks what happened with Silicon Valley Bank last year in, March of last year? He thinks that same thing, similar thing is going to happen, but this time, no bailouts. There will be, what will probably happen are bail-ins, where basically the depositors will have to bail out the bank. And it will create a nasty recession. And what's going to be terrible is those individuals out there who have payroll and are mid-sized businesses, that could be devastating. And then everything slows down, and then some of the banks will lose their money, or some of these companies. You could see bankruptcies of some of these companies out there because they won't be able to make payroll, because guess what? The banks have gone under and they can't bail it out because the FDIC doesn't have enough money. And it's only, they say they'll only reimburse $250,000 lost. A mid-sized business has to pay more than $250,000 in payroll. They keep a lot of money in the bank to make payroll. A lot of us don't know this. I used to do payroll, and I used to look at the bank account of a smaller company over a decade ago. So I've seen this firsthand. Cash is very precious, and a few $100,000 is devastating for a small business if they lose it. A bigger company could find ways to get funds, sell stocks, sell property. Maybe they have treasuries, which are liquid securities. They could convert to cash. Yeah, everyone's going to take a hit, but some of these bigger companies should be able to bounce back. Smaller companies, they're going to get smoked, in my opinion, this recession if their bank goes under. Now, some people say this is insane. I don't think it's insane. So, first half, my prediction, everything should seem fine. But there are problems underneath the surface, and the biggest indicator is that yield curve. Negative yield curve. And two, I think Jim Cramer said the other day that, yeah, he's very bullish in 2024. That's a warning sign, guys. Warning, warning, warning. Jim Cramer's bullish for this year. Red flag, red flag, red flag. Anyways, hope you have a nice new year. And let's hope that I'm wrong. But anyways, I'll talk to you later. See ya. Bye.